Hello, everyone. Welcome back to another installment of the Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an equity strategist here at Zacks Investment Research. And today we are creating a little bit of an update to a video that I made over 2 years ago, and that is titled "The Little Screen That Beats the Market." So let's get started and take a look at what exactly that is. So over 2 years ago, it's been almost 2.5 years now. I made a video titled "The Little Screen That Beats the Market," and you can search for it on YouTube on our YouTube channel. In case you're not familiar, our YouTube channel is just Zacks Pro, and if you just search "The Little Screen That Beats the Market" with Zacks Pro, you'll see that video there. This was made back in November of 2022. And so this video is an update to that video with commentary and updated performance figures. So let's take a look at exactly what that is. So in case you missed it the first time, I just want to give you a brief summary and intro into what this is. And this screen that I put together is super simple, and it's based on ROIC. And if you've been following me here, return on invested capital is probably the number one metric that I like to focus on, almost even above growth. Growth is what, most people talk about and think about when making investments. But I think, alongside growth, certainly growth is important, but alongside growth, something that a variable that almost nobody talks about is return on invested capital. And the idea is that companies that have high growth and high returns on invested capital outperform similar high growth companies with lower ROIC. And this is because high ROIC means that the company is generating more free cash flow, which gives the company additional options that are not available to the low ROIC business, such as debt paydown, strategic M&A, share buybacks, or just a generally greater ability to reinvest capital back into the business. So to give you a brief example, a very simple example, let's say there's two hypothetical companies, XYZ Corporation and ABC Corporation. Now, on this table at the very top, you'll see that I have, both companies starting from a base of $1 per share at year zero. And let's assume that both companies grow at 10% per year. So you can see that, after year one, both companies are earning $1.10, and then year two, $1.21, $1.33, $1.46, $1.61. So after 5 years, with both companies compounding at 10% per annum, you'll see that by year five, both companies will be earning $1.61 per share, right? So theoretically, they have the same exact growth. So in theory, they should have roughly the same return in the market. However, there's a big caveat to that, and it doesn't even have to do with valuation. Let's take the next step beyond that. Let's say that both companies started with a capital base, meaning the total amount of capital that the companies started with, right? Because remember, before you even have a company that starts generating revenue, you have to have investors that invest capital into the business, either debt or equity or both, right? So let's say both companies started with $10 of invested capital, right? That is the capital base, meaning shareholders and bondholders together contributed $10 into the company total to get the business started. And let's say that one company, right, was growing at 10% per year, meaning they had to increase the amount of capital back into the business. In order to get this growth, you have to still reinvest some of that money back into the business, right? Because if you're scaling up, then you need more and more capital reinvested into your business in order to generate the growth that you see here on the top part of the table. So I assumed that, for XYZ, the growth rate of capital was 10%. So here you can see that after year five, $10 of invested capital is now $14.69 of invested capital. And now for company ABC, I assumed a 12%, growth rate over time. So there you can see that by year five, you have $16.11 of total invested capital. So if you look at it, the numerator over the denominator tells you the ROIC. So, the ROIC in other words, tells you the return that each company is generating on its invested capital base, meaning how much profit are you generating per dollar of capital that you invested into the business itself. So this is actually what's telling you what the ROIC is that it's telling you what is the rate of return that the company is generating on the capital that it invested into the business, right? It's almost like the interest rate. For example, you open up a bank account right now, and let's say it's a high yield savings account right now, with the Fed funds rate at roughly 4%, your bank might be paying you, I don't know, 3.5 to maybe 4%, right? So that would be your ROIC for every dollar of money that you deposit into that high interest savings account. So your ROIC on $10 of capital would be 4% because you'd be earning roughly 4 cents per $10 that you invest, or sorry, 40 cents per $10 that you invest. That's your ROIC. So in the same way, companies have their own ROIC. They have a capital, a base of capital that they invested to buy the property, the equipment, and other things that go into the business. And then you have your profit that the company generated. So your profit divided by the total capital that you invested in the first place tells you your ROIC. And so over time, you can see here that the ROIC of XYZ is actually increasing despite the fact that, profits are growing at 10% and the capital base is growing at 10%. You can see that the ROIC over time is increasing from 10% to 11% by year five. And in contrast, ABC, because they're also scaling up in terms of the capital required to generate this 10% growth, you can see that ABC's ROIC has stayed flat the entire time, 10%. All I'm doing is taking the profit divided by the capital base, and that gives you the ROIC. So what this is telling you is that XYZ is getting more and more efficient, meaning it's generating more incremental earnings than the incremental amount of capital that needed to be reinvested into the business. So what does that mean? It means that, by year five, the amount of cash that XYZ is going to have on its balance sheet is going to exceed the amount of cash that ABC has on its balance sheet by the end of the fifth year. You can see that all this is doing is that it's taking the incremental profit every year, minus the growth in the capital base. So here we have $1.10, and by year one, we had to reinvest $1. So the net change would be 10 cents. So that's why you see that this grew from 100 to $100.10. And the same thing goes for each subsequent year. The second year, we generated $1.21. And in year two, the capital base went from $11 to $11.99. That is an increase of 99 cents. So we generated $1.21 of earnings that year, and had to only reinvest 99 cents of that. So the excess amount is roughly 30 or 22 cents. So this went from $100.10, and that increased by 22 cents. So that gives us $100.32. As you can see here, there's starting to be a separation. And so by year five, if you keep going out, into the outer years here, you can see that XYZ now has more cash on its balance sheet than ABC does. So over time, the fact that, XYZ has a more attractive ROIC is basically telling you that XYZ is going to have more cash on the balance sheet because it generated more free cash flow over time, despite the fact that both companies had exactly the same starting point of $1 of earnings, and despite the fact that both companies grew at 10%. So despite the fact that we have identical earnings, and this is presenting the same table but in graphical form, you can see that the earnings growth is identical for both companies. But the capital deployed for ABC is greater than the capital deployed for XYZ, which means that ABC is more capital intensive than XYZ is. And because of that greater capital intensity, you have lower ROIC for ABC and therefore lower cash balance for ABC than XYZ. That excess cash that XYZ is generating is going to lead to a better return for shareholders over time because this means that this company has more free cash flow left over for them to do things like the things that I mentioned over here, paying down debt, strategic M&A, share buybacks or dividends, or a greater ability to reinvest capital back into the business. So because this company has more cash left over, they can redeploy that back into themselves and therefore generate even better growth in the outer years. So this is why ROIC is so important because two businesses growing at the exact same rate can have very different outcomes in 5, 10, and 15 years. So the takeaway here is that growth is important, no doubt, but ROIC is equally as important as it tells you how much capital is required to generate said growth. So the little screen that beats the market, right? This is the little title that I gave it. It uses just three criteria. Number one, it has to be an S&P 500 member. Number two, from those 500 companies, we want to find the top 30 percentile in terms of the change in ROIC. So going back to this, we're looking for companies that have something like XYZ, where you can see that the ROIC is growing over time. We want to see evidence that capital efficiency is increasing over time because embedded in an increasing ROIC is increasing growth. But what we want to see is growth with attractive economics, with attractive capital efficiency. Because what that tells you is that this company is generating more and more free cash flow. That's the key here. So we want the top 30 percentile of S&P 500 companies in terms of not the ROIC, but the change in ROIC. And this is defined as the current ROIC, which uses a trailing 12-month net income divided by the capital base, minus the 5-year average ROIC. So we want to see the companies that have had the biggest deviation in terms of current ROIC versus the 5-year average ROIC. Okay, so once we've gotten that top 30% of S&P companies based on that change in ROIC, we then want to pick the top 10% of that top 30% in terms of revenue growth predictability. So we want growth on the top line and we want increasing efficiency on the bottom line. This is what this is telling you. This combination of revenue growth and increasing capital efficiency on the bottom line is a very, very powerful combination. And I'll show you exactly, what the results of that has been. But this criteria basically results in exactly 15 stocks because you're starting with 500, the top 30% of that, and then the top 10% of that gets you exactly 15 stocks. And I set the rebalance frequency to every 12 weeks, meaning you buy the 15 stocks and assume you hold it for 12 weeks and then run a rebalance at that time and then pick the companies that pass the screen at that time and then set it, and hold it for another 12 weeks, rinse and repeat. So what does that do? Look at these results here. So this is a back test from 2001 or 2000 to 2025. through May of 2025. And you can see that this little screen here with just three criteria has really completely destroyed the market in terms of returns. This has been quite a eye-popping, result here. If you were to simply follow this algorithmically without any thinking, without any other adjustments, your return would be double the market's return. As you can see here, 1,200% versus 629% over this entire 25-year period. You can see that the win ratio has been 68%, although the S&P is a little bit higher on the win ratio, but I would say that the two are not, materially different. You can see the compounded, annual growth rate is 11.3% versus 8.6 for the S&P 500. This gives you roughly a turnover of 20%, which is high, but not terribly high. For a screen that rebalances every 12 weeks. That's quite a high rebalance frequency. So every, 4 times a year, you are turning the portfolio over, but it really results in just 20% of an actual turnover in terms of the change of, in terms of the holdings. Um, and, uh, and so this has been a terrific, sort of method to generate some really high octane results. And then if you look at it a little bit more recently, you can see that a lot of it was, in that second half of the back test, you can see that the results were kind of close to one another. The screen was beating the S&P, really from the get-go here. But then the S&P really caught up during this stretch between 2006 to 2008. But then following that period after 2009, you can see that the separation really started to happen. So I zoomed in on that little period there. So this is the performance from 2015 to 2025. And you can see that the results have really, continued to work even during this strong bull market period, even through that COVID crash in 2020, and the post-COVID recovery. It's been, a really terrific performer. Um, so, I just wanted to bring your attention to that. If you have any questions, I'd love to hear from you. But again, ROIC has just been one of my favorite metrics, and this has been probably the best exercise that I've, come up with regards to how well ROIC works in practice, from, a stock selection standpoint. The ROIC metric has been, embedded in the stock selection strategy of the Zacks earnings certain proxy. And this has been a bedrock principle of mine personally as well. So ROIC is definitely a major stock selection criteria for our, Zacks earnings certain model portfolios. But if you wanted something with even more octane, with a little bit more risk and return, this screen is a great, way for you to get some, really good high growth, high, sort of higher beta, I should say, ideas. So if you want this screen, if you want to see the companies that match the screen results. If you want to plug this in, if you do have access to the Zacks Advisor Tools screener, or the ZRS screener, I would be more than happy to send you the screening criteria so that you can run this and see the stocks that currently match the screen. And so if you do want that, please do reach out to us. You can reach us at 1-866-794-6065, or send us an email at strategycall@zackspro.com, and I would be happy to send you either the slides that you see here, and or the screening criteria, or I can even send you a simple spreadsheet that contains the current stocks that match the criteria. So hope you found this helpful. Again, love to hear from you. Any feedback, questions, please do reach out to us. Thanks, and talk to you soon again. Bye.